A few years ago, buy now pay later felt harmless. You saw a pair of sneakers online for $120, but instead of paying the full amount, the app told you something that sounded almost too easy. Pay just $30 today. No interest, no stress, no credit card required. Suddenly, expensive things didn't feel expensive anymore. Phones, clothes, gaming consoles, concert tickets, even food deliveries started getting split into tiny payments that looked completely manageable. Millions of people jumped into BNPL because it felt smarter than using a credit card. It felt modern, flexible, and safe. But now, something huge is changing that most people still don't fully understand. Those small installment payments are no longer staying hidden in the background. Buy now pay later is starting to appear on credit reports, and that could change the way banks, lenders, and financial institutions see you forever. Imagine applying for a car loan, a mortgage, or even a new credit card, only for the lender to see dozens of small BNPL loans attached to your name. Even worse, imagine missing one tiny payment you completely forgot about and suddenly watching your credit score drop because of a $20 purchase. That's the reality many people are about to face. What started as a convenient shopping tool is slowly becoming part of the credit system itself, and most consumers are completely unprepared for what that means. In today's video, we're breaking down everything you need to know about the new BNPL credit reporting changes, how they can affect your credit score, why lenders are becoming worried about installment shopping behavior, and the hidden risks nobody talks about. We'll also explain whether BNPL can actually help your credit, or if it's quietly becoming another debt trap disguised as convenience. Because the truth is, the financial world is changing fast, and if you don't understand how these systems work, you could damage your financial future without even realizing it. By the end of this video, you'll know exactly how buy now pay later works behind the scenes, what credit bureaus are starting to track, and the smartest ways to use BNPL without hurting your score. So before you split your next payment into 4 easy installments, make sure you watch this video until the end, because what lenders now see about your spending habits might surprise you. Buy now, pay later didn't become popular by accident. It exploded because it changed the way people psychologically experience spending money. When people see a product that costs $200, their brain immediately evaluates whether they can afford it. But when the same product is presented as for easy payments of $50, the purchase suddenly feels smaller, lighter, and emotionally easier to justify. That's the real power of BNPL. It reduces the pain of paying. Companies understood this perfectly, and online retailers quickly integrated BNPL options directly into checkout pages because they realized customers were spending more money when payments were split into installments. Social media also played a huge role. Influencers normalized financing everyday purchases, and younger consumers especially began treating installment payments as a normal part of shopping culture. Many people even believed BNPL was safer than credit cards because it often came without traditional interest charges. But the problem is that convenience can create dangerous habits. When every purchase feels affordable, people stop tracking how much they truly owe in total. One payment here, another payment there, and suddenly someone has 10 active installment plans at the same time. That's where the hidden danger begins. BNPL doesn't just change how people pay, it changes how people think about money itself. And that psychological shift is exactly why financial experts are starting to pay close attention. To understand why BNPL appearing on credit reports matters so much, you first need to understand how credit scores actually work. Your credit score is basically a financial trust score that tells lenders how risky you are as a borrower. The biggest factor is payment history. If you consistently pay your debts on time, your score improves. If you miss payments, your score can drop quickly. Another major factor is credit utilization, which measures how much of your available credit you're using. Then there's the length of your credit history, the number of accounts you open, and the types of credit you use. Traditional credit cards have always influenced these categories because banks regularly report your activity to credit bureaus. But BNPL operated differently for years. Many providers either didn't report purchases at all or only reported missed payments. That created a strange system where consumers could borrow repeatedly through BNPL without it fully appearing in their credit profile. Too many people that sounded like a benefit. But lenders started realizing they couldn't see the full financial picture of borrowers anymore. Someone might look financially stable on paper while secretly juggling dozens of installment payments behind the scenes. That's why the industry is changing. Credit bureaus and lenders want more visibility into short-term borrowing habits, and BNPL data is becoming part of that equation. The invisible debt era is slowly ending. Now we're entering a completely new phase where, buy now, pay later companies are increasingly reporting customer activity to credit bureaus. Some providers already share data about missed payments, while others are beginning to report full payment histories, including on-time payments and active installment plans. This means lenders may soon see far more information about your financial behavior than ever before. Even if each individual purchase seems small, the overall pattern can tell a very different story. Imagine someone using BNPL for clothes, electronics, travel tickets, furniture, and groceries all at once. Individually, each payment might seem manageable, but together they could signal financial dependence on short-term borrowing. Another important factor is credit inquiries. Some BNPL services use soft inquiries, which don't impact your score, while others may use hard inquiries that can temporarily lower it. Most consumers never pay attention to these details because the applications feel so quick and casual. That's part of what makes BNPL psychologically dangerous. It doesn't feel like taking out a loan, even though that's exactly what it is. As reporting expands, lenders will start evaluating not only whether you pay on time, but also how often you rely on installment financing in the first place. In other words, your shopping habits themselves could become part of your financial reputation, and many people are only beginning to realize that now. One of the biggest misconceptions about buy now pay later is that small payments can't cause serious financial damage. But the truth is, missed BNPL payments can hurt your credit score just like missing credit card payments or loan payments. The danger comes from how easy these installment plans are to forget. Unlike a single monthly credit card bill, BNPL often creates multiple payment schedules across different apps and retailers. A person might have 5 or 6 separate due dates every month without realizing how quickly things can spiral out of control. Even worse, people often underestimate the total amount they owe because the payments are divided into smaller chunks. This creates what experts sometimes call phantom debt, where consumers feel financially stable while carrying far more obligations than they consciously recognize. Missing just one payment could lead to late fees, collections, or negative marks on your credit report depending on the provider. Another issue is account volume. Opening too many BNPL plans in a short period can make lenders nervous because it may look like financial stress or overspending behavior. Some lenders may even view excessive BNPL usage as a warning sign that someone is struggling with cash flow. What feels like harmless convenience today could quietly reduce your ability to qualify for larger financial goals tomorrow, including car loans, apartments, or mortgages. Even though there are risks, buy now pay later isn't automatically bad. In some situations, it can actually help people build healthier credit habits if it's used responsibly. For younger consumers or people with very limited credit history, making consistent on-time payments through certain BNPL providers could potentially help establish a positive financial track record. This is especially important for people who struggle to qualify for traditional credit cards. Some BNPL services are starting to market themselves as tools for financial inclusion, allowing users to demonstrate responsible borrowing behavior without relying on high-interest credit cards. But there's a major catch that many consumers don't understand. Not all providers report positive payments to credit bureaus. Some only report missed payments or defaults. That means you could be taking on all the repayment responsibility without receiving much benefit to your actual credit score. In other words, the system may punish mistakes more aggressively than it rewards good behavior. Another problem is that even on-time payments don't erase the risk of overconsumption. Someone could technically pay every installment on schedule while still developing unhealthy spending habits underneath the surface. That's why discipline matters more than the app itself. BNPL can be useful when it's treated as a controlled financial tool, but it becomes dangerous when people start using installment plans as a way to buy things they realistically couldn't afford upfront in the first place. One area where BNPL usage may become especially important is mortgage and loan applications. Banks don't just look at your credit score when deciding whether to approve you. They also study your overall financial behavior and debt obligations. If lenders notice frequent buy now pay later usage across your accounts, they may begin questioning how dependent you are on short-term borrowing. Imagine two applicants with similar incomes and similar credit scores. One rarely uses installment financing, while the other constantly finances small everyday purchases through multiple BNPL apps. Even if both people pay on time, lenders may still see the second applicant as financially riskier because the borrowing behavior itself suggests less stability. Mortgage underwriters are particularly sensitive to patterns that indicate overspending or cash flow problems. Financing luxury items occasionally is one thing, but financing groceries, food delivery, or basic living expenses could send a completely different signal. Another important issue is debt-to-income ratio, which measures how much monthly debt you already carry compared to your income. Even small installment payments can add up and affect this calculation. Many consumers don't realize that lenders may eventually view excessive BNPL usage similarly to revolving debt. This is why financial experts are warning people to be careful, especially before applying for major loans. What feels like harmless flexibility today could become a red flag during future financial decisions. The most dangerous part of buy now pay later may not be the payments themselves. It may be the psychology behind them. BNPL changes the emotional experience of spending money in a very powerful way. When people pay in full upfront, there's immediate financial friction. You feel the true cost of the purchase instantly. But installment payments weaken that emotional resistance because the brain focuses on the smaller short-term amount instead of the total price. That's why people often spend far more using BNPL than they originally planned. Retailers know this very well. Studies consistently show that customers spend more money when payment options are divided into installments. Over time, this can create a dangerous cycle where affordability becomes an illusion. A person may think they are managing their finances responsibly because each payment feels small, but underneath the surface, they're accumulating obligations across multiple platforms. Social media has made this even worse by normalizing constant consumption and instant gratification. People see influencers buying expensive products every day, and BNPL makes those lifestyles appear financially accessible. But many consumers eventually reach a point where they lose track of how many payments they actually owe. The problem isn't just debt, it's behavioral conditioning. BNPL trains people to prioritize immediate satisfaction over long-term financial stability, and that mindset can quietly damage financial health for years without people realizing it. The good news is that buy now pay later can still be used safely if you approach it with discipline and awareness. The first rule is simple. Only use BNPL for purchases you could already afford with cash. If you genuinely cannot afford the item without splitting payments, that's often a warning sign that you shouldn't buy it at all. Another smart strategy is limiting yourself to one active installment plan at a time, whenever possible. The biggest problems usually happen when people stack multiple payment schedules across different apps. It also helps to turn on autopay and calendar reminders, because missed payments often happen due to forgetfulness rather than lack of money. You should also avoid using BNPL for essentials like groceries, rent, gas, or utility bills because that can indicate growing financial stress. Instead, BNPL should only be used occasionally for planned purchases that fit comfortably within your budget. It's also important to research whether your provider reports activity to credit bureaus so you understand the possible impact on your credit profile. Most importantly, start treating buy now pay later exactly like real debt, because financially speaking, that's what it is. The era of invisible installment spending is disappearing. Lenders are paying closer attention. Credit systems are evolving, and your financial habits matter more than ever before. Smart consumers will adapt early instead of learning the hard way later. So at the end of the day, buy now pay later is not just a payment option anymore. It's becoming part of your financial identity. For years, people treated BNPL like invisible money because the payments were small, easy, and disconnected from traditional credit systems. But that era is changing fast. Credit bureaus, lenders, and banks are starting to look much more closely at how consumers use installment financing. And the habits people build today could shape their financial future tomorrow. The scary part is that most people don't even realize how quickly small payments can turn into long-term financial pressure. A few installments may seem harmless, but when spending becomes emotional and borrowing becomes automatic, that's when financial control slowly disappears. The real issue was never just about buying things in for payments. The real issue is whether people are spending based on true affordability or just temporary convenience. Because eventually, every payment catches up. The good news is that BNPL itself is not evil. Like any financial tool, it depends on how responsibly you use it. If you stay disciplined, track your payments, avoid impulse spending, and treat installment plans like real debt, you can protect your credit and your future. But if you ignore the risks, these small payments can quietly damage your financial life in ways you never expected. So the next time an app tells you pay later, Ask yourself one important question. Are you buying something you can truly afford, or are you simply delaying a financial problem for the future version of yourself? That one question can change the way you handle money forever. If you found this video valuable, make sure to like, subscribe, and turn on notifications, because we break down the hidden financial systems most people never learn about until it's too late. And comment below. Do you think buy now pay later is smarter than credit cards, or is it just another debt trap in disguise? I'd love to hear your thoughts.